If everybody could comment in the meeting chat whether you've attended any of the trainings before or not, because you all look new. And if that's the case, I can go back through some of the previous material and make it a more general presentation. So just comment in the meeting chat whether you attended the previous session or not. Okay, so it looks like a couple of you attended the intro session, but not necessarily session number 1. And since it doesn't look like I have anybody from session 1 here yet, I have no problems going over some of the basics to get everybody on the same page. So with that said, I'm going to scroll on down here. Excuse me here while I go through this. So that I can start back up at the top, and it's going to be pretty much drinking from a fire hose here, because I want to make sure that everyone has a good understanding of the basics before I go into really some of the complicated stuff. So with that being said, I am Danielle, and a lot of you I've met in person. Some of you I haven't met, but quick disclaimer, I'm here working from home and I have some loud dogs. If someone happens to knock on the door or something like that, I apologize in advance. But just the nature of the beast, I tell you. It looks like I've got Judith joining as well, and Judith was with me last week. I know that for sure. So Judith, just for your purposes, I'm going to go through the basics again because I have a lot of new people on the line, and I'll try and run through that as quick as possible, but then I can jump into session 2 after that. But I think without understanding what's happening from session 1, session 2 is going to be a hard digest. So with that being said, I'm going to go ahead and start because we have very little time. And oh, see, it's already starting. Got the barking in the background. I'm gonna mute for just 1 minute and I'll be right back. Okay, apologies. I have a litter of puppies and they're going crazy. With that, I am gonna jump into session 1 and talk about commercial basics, some of the asset types, some of the zoning, and asset classes and leases. So that'll give you pretty much a basic understanding of some of the commercial terminology. A lot of you do know the difference between residential and commercial. And you do know that in residential, you can manage up to 1 to 4 units of investment properties with the standard card contracts and with your E&O insurance. Anything above and beyond that is considered commercial, and you're not covered from E&O. So you really need to work with a commercial agent or join the commercial team and get the exhaustive training that's required. So with that being said, session 1, we talked about asset classes. There's different types of classes in commercial real estate, and they're all different types, and they vary in terms of functionality, what it's being used for, how many upgrades it has. And so I'm going to talk quickly about that. But an asset class, and there's a specialty focus where you can be looking at how you generate rental income, the goal of appreciation, and different variables like that. So one of the ways that we understand that it's a commercial property, not a residential property, is the land use. So how many people, just by a show of hands, maybe have dealt with land use or trying to re-entitle or get a general plan amendment through on any real estate transaction they've ever done? just say yes or no in the comments. That would be great. That's pretty much what commercial is all about. It's really about understanding the underlying land use, understanding what that municipality has from a general plan, a strategic plan, what are the services, and what is the municipal code. So if you like research, this is an area for you. If you don't, it's not. So let's say, for example, you have some raw land and it's currently zoned agricultural. And the general plan has identified that it's in the urban growth boundary. And the urban growth boundary means, okay, I am in the city of San Jose, and now I want to encroach into the county of Santa Clara and acquire some land to bring into the city, and so that we're going to expand our services. So county normally doesn't have those city services. Think police, water, sewer, all of those sorts of things. And it has to be in a general plan or a strategic plan for the city to say, yes, this is an area we want to grab and pull into our infrastructure. And without that, you're really just operating on most likely agricultural land or land that you're going to have a well, and you're going to have a sewer on. So understanding if something's in the city, what if it's in the urban growth boundary, what sort of infrastructure it has, is the basic level understanding. Then once it's in the city or in the county or wherever it happens to be, you're going to have to go and you're going to have to look at the muni code, the municipal code. And that municipal code is going to give you the land use. And the land use is super complicated because it could be zoned residential, it could be zoned retail, it could be zoned industrial. Industrial could be light industrial, it could be heavy industrial. And then you're going to have separate areas of industrial where you could potentially, and how you would use that land or that particular building or that site. So if it's zoned light industrial, can you do manufacturing? Can you do self-storage? Can you do distribution? And then in the municipal code, it's going to tell you whether you have by right, whether you have to get a conditional use permit, whether you have to get a general plan amendment, whether you have to get planning approval. So now you're starting to deal with, okay, it's zoned for that, it allows for that, but what are the steps in order to get the approval to make it happen? So that's when we start talking entitlements, and a lot of people hear that term. So it might be a property that's zoned for something, but you may have to go through planning approval to actually do what you want to do there. And that could take 3, 4, 5, 6 months, 2 years. And you need to factor in whether you're going to add that into your due diligence period. So it starts getting super complicated. So let's understanding land use, interpreting the data, understanding really the zoning ordinance. So I'm going to scroll down here real quick, and you'll see in this table down below, table 2.20-1, you'll see that in these use classifications, residences like single family, the zoning, there's A, AR, HS, and RR. A lot of you are probably very familiar with those because that's residential real estate. Then you have to say, okay, well, that particular house or land or parcel is zoned AR. What does that mean? So then you have to go into the use regulation to understand what that means. And then under AR, you would normally scroll down to understand if it's permitted by right. Do you need planning clearance? Do you need ASA, use permits? So again, it's a research-oriented activity. So that's really just like the basics, you know, how can that particular site, property, or land be utilized based on the commercial needs of my client? So level setting in terms of what that means. There's 10 types of commercial real estate, and I'm going to go over those real quick. And then there's some the 2 of those are emerging areas. So just think verticals, right? In terms of what are those vertical asset types and those different specialties. And a lot of you are very familiar with multifamily. You are also familiar with office. We've all been into offices. There's industrial, there's retail, hotels and hospitality, land, you've got mixed use, special purpose. Now think special purpose is church. It could be an event center, it could be a school. Then the two emerging areas are self-storage and life sciences. So I'm not going to necessarily go into these because this was from the previous session, but if anybody has any questions on any of those asset types, just put it in the comments and I can address it. But I think the majority of you really understand what those asset types are. But I wanted you to have a good picture of those 10 types so that you can keep that in your back pocket. I'm not going to go through these details because again, this was from last week, but you can see on this presentation and I can share it with you. It goes into a little bit more detail on all of these different asset classes or asset types. Now, what the heck is an asset class? So let's say you want to help your client purchase a quad, a fourplex. You're still going to need to know what a real estate asset class is, because that asset class is going to be identified by either A, B, or C. And understanding the asset class helps you understand whether it's a value add opportunity or if it's really a cash flow opportunity, or if it's something that you're going to be paying top dollar for, but you want very minimal headaches when it comes to managing that. So asset class is a class that investors use to generate returns. So let's say, and I'm going to give a couple of examples. You've got a beautiful office building. It's fully kitted out. It's, marble floors. It's updated. It's got all of the bells and whistles. That's a level A asset class. And ideally, someone's going to purchase that because there's going to be it's going to be minimal outlays in terms of management, minimal outlays in terms of maintenance. And they probably are looking for a higher level of clientele with the least amount of headaches. Now, I always think of it from a value versus a volume play. Let's just say an investor has $5 million. They can buy, a very nice office building that's a class A, or they could buy 4 or 5 smaller ones that are class C. So then they're looking at more of a volume play. But then again, your clientele is going to be different. The location is going to be different. There's going to be all kinds of different dynamics with regards to density or other things of that nature. So understanding asset classes is super important when dealing with commercial real estate. Here's a little bit more detail about that. Class A is property in a prime location. It's kept up, cream of the crop, but you're going to get a price tag to match. So critically think through this, right? If it's a Class A real estate, are you going to have a higher cash flow? Or are you going to have potentially less cash flow? Most likely, if you're first in to buy it right now, the cash flow is going to be not as high as if you start building up the equity, and then over time your cash flow is going to get a little bit higher. And people look at cap rates. Cap rates is essentially an equation that you use to see if it's a good investment. And some people think that a certain cap rate is ideal. And to me, that doesn't really make sense, because you can have a higher cap rate in a Class C opportunity that has been held for quite a long time, because the value of that property is sitting at a purchase price from 10 years ago. Now, if you go buy a new property or property at today's prices, you might get a lower cap rate. But again, you're buying in a prime area and you're buying a better asset. So sometimes these numbers can be confusing and they're not as indicative of your investment. So it's something to just really understand and think about. And the reason I'm going through all of these different terms is for all of you to have this in your back pocket, so you feel like you really understand these terms. So when someone brings them up, you at least have a baseline understanding and you're able to talk intelligently to your clients, but then also feel like you can at least hold the conversation long enough that you can bring in one of the commercial agents in our in our office to help you seal a deal and help you manage a referral and manage that income stream potentially from one of your existing clients. And I've said this time and time again, and apologies again for my dogs, but every single commercial real estate asset owner is also what? A residential homeowner. And all of you manage those residential homeowners. So every single one of your clients, I would have a sneaking suspicion in the Bay Area, also has an asset that may be considered commercial. So that's something to think of and to actually inquire. It's a good reason to actually reach out to some of your clients today and say, okay, well, I've been waiting for a reason to talk to them. So I'm going to pick up the phone and give them a quick call and just say, you know, I'm curious, do you have any investments? Have you thought about doing any investments? Have you thought about getting into commercial real estate and expanding your portfolio? And if so, we have an amazing commercial team, and we can partner together with the commercial team to make sure we meet all your needs. And even if you're not thinking of that today, we can look at your future and see where you may want to be investing in the future. One of the things that a lot of people don't realize that KW Commercial is actually the second largest commercial organization in the United States today. We've actually surpassed, I think, Collier's, and we're right behind CBRE. And the reason for that is that we have so many agents that are relying on our residential counterparts that we're growing exponentially. So don't think we're boutique. We're not. We are playing with the big boys right now. And the resources that we have at our fingertips from a commercial agency is amazing. We have a wonderful community and team that just gives us everything that we need in order to be successful and compete with the people that are the perceived larger players. And I say perceived because nobody really knows KW Commercial is second in the nation right now. One of the other areas that's kind of a high level for commercial is lease types. What are those different types of leases? And this gets super complicated again. So it's not just a residential lease. I just did a lease this morning. I'm working on an LOI for a lease, and it's for a multi-unit retail site. Now, why is that important? Well, I know because it's multi-unit that most likely it's going to be a gross lease. And a lot of you are thinking, what the heck is a gross lease? Well, let me talk a little bit about lease types. You have a single net lease, you have a triple net lease, you have a double net, and basically one of these triple nets is supposed to say gross lease on it right here. That's the gross lease that I was talking about. Single net is where the tenant is responsible for paying the property taxes on top of the rent. Double net is what the tenant pays for taxes and insurance. Now, triple net is where they pay for the taxes, insurance, and maintenance of the property. So think, you know, big, huge warehouse or big, huge distribution center. That's going to be a triple net lease because it's one tenant. That tenant is going to probably manage everything, maintenance and everything. So again, when you're representing a client, it's good to know what class that property is, because if it's a class C and you're helping them sign a what you think is a great lease, well, oops, it's triple net and they have to manage the maintenance. What if there's tons of deferred maintenance? Now that great lease doesn't look so good. So it's much more complicated than a lot of people give it. So it's something to really recognize. And where it says triple net over here on the right-hand bottom corner, it really is gross. I signed a gross lease, and the reason is that the tenant is only responsible for the rent of the property, but it's a multi-tenant property. And what I mean by that is think medical condos, where you go into a building and your dentist has one little condo space, and you know there might be an orthopedic surgeon that has another condo space, and they own those, but they're not going to have a triple net lease because they're not going to pay the property taxes for everybody. It's not going to be prorated. So normally it's going to be just a gross lease because it's multiple tenants in one building. So again, nuances to all of this. Is there any questions? Feel free to post it in chat or whatever, or raise your hand or just scream or whatever makes sense. I'm good with that. And I will send you all the slides. I see Melinda asked for that. I'm not going to talk about client profiles, but again, one of the purposes of this is that because Keller Williams Commercial has become such a big entity and we're really, really blowing out our numbers, we really want to make sure that all of the residential agents know that we can be a resource for a huge referral income stream. And then also, we can provide scripts for you for your conversations with your existing clients, and then we're going to provide support. And we're never going to steal your residential clients. We're focused completely on commercial, and we'll make sure that we bring you along that path as well. And also, if it's an area you want to learn about, I have no problems having someone partner with me on a commercial deal. I have to lead it because of the E&O insurance. But I'm a big advocate of also getting more women in commercial real estate. I just don't think there's enough. So that's an opportunity as well for a lot of us. So I'm going to jump to where we originally were supposed to start, which is session 2 here. And we're going to talk a little bit about commercial real estate financing, the real estate returns, and some of the risk. Again, the real estate financing is much more complicated than your typical financing of a home or a duplex or a triplex or something like that. Usually in commercial with large assets, you have what's called a capital stack. Think pancakes, right? You have layers you have multiple pancakes stacked up, and you may have different types of funding in that capital stack or that stack of pancakes that you have to rely on to get a deal done. If it's 60 million, you may get a mortgage for a portion of that. You may need mezzanine funding for another portion. You may go out and do some syndicate funding. So there's all different ways in commercial real estate to do funding and financing. And this is why I love it, because it's so darn complicated. If you like big, hairy, complicated deals, this is where it's at. But then again, it's not for the faint of heart, and a lot of these deals take a long time to pull together. So you got to recognize that, you know, the 30 days of listing and within 60 days you have a commission check. That just doesn't happen in commercial. It takes much longer. So types of commercial real estate loans, you've got your conventional commercial real estate loans and the mortgage loans. And that's what you use for single family. And sometimes investors can use those conventional commercial loans to structure some of those deals, but I hardly ever see that. Conventional commercial loan terms is really where lenders typically require 25% down. And the fixed rate is from 5 to 30 years, as you probably know. Then you can go into the commercial bridge loans. Now, a bridge loan is usually a short-term loan, 6 to 12 months, and they come with a higher interest rate, and you have to pay that back within a very short period of time. And think a bridge loan, I use bridge loans in cross collateralization. So say, for example, I've got 2 properties and I'm going to sell both of those properties to buy something else, and I want to do maybe a reverse 1031. So I go and I find a site that's amazing. I have to have that site, and I don't have the cash, or I'm not going to, what I'm going to do is sell 2 other properties to get that one site. Then I go and I get a bridge loan. And then what they'll do is they'll put a lien on my 2 other properties I currently have that will secure the target property. Then for a short period of time, I'm paying the mortgage on all of those while I'm trying to sell the 2 properties I have in hand. And then by the time I sell those, I pay off the bridge loan, and then I've got my target property. So that's usually where I see that coming into play. And it also may be, you know, just short-term capital until you can get a debt servicer to come on board to help you with your capital stack. Commercial hard money, a lot of you are probably familiar with hard money lenders. This is really DSCR lenders, debt service coverage ratio. So a debt service coverage ratio is, let's say hypothetically, you're going to buy a 10-unit apartment complex, and your monthly payments are going to be, I'm making this up for round numbers, it's going to be, you know, I don't know, let's just say 10,000 a month, but your income is going to be 12,000 a month because you're renting it out for a really good rate and you're getting a deal on it. You could get a lender to finance that without proof of funds, without anything else, because they're going to secure it based on the debt service coverage ratio being met, which means the income you have is 120% of the debt that you're taking out. And that's a typical hard money loan. High risk situations with high interest rates, it could be 10 to 20%, but also going back, the bridge loan can be 10 to 20%. It's kind of crazy. The other thing that a lot of people don't realize is a lot of these commercial financing lenders and loans are typically 3, 5, 10 years maximum. And then there's a large balloon payment. So one of the things that we're seeing in the industry right now is that people took out loans 3 years ago at a pretty darn good interest rate, let's just say hypothetically 4, and now it's coming to maturity, and now they're being hit with an 8% rate. So a lot of those people are defaulting, or they're walking away, or they're selling distressed. Any questions thus far? Okay, types of loans, and there's also the SBA 7A loan, and there's another SBA loan. It's called the SBA 504 loan. These are kind of interesting for people that are really running a business. Say, all of a sudden you started creating widgets, and those widgets are flying off the shelf, and you've got a facility where you're manufacturing them, and you're actually shipping them out of that facility. And now you want to go buy a commercial asset and operate your business out of it. So normally an SBA loan would be used in that sort of situation, an owner user. And there's certain criteria in that. And so the SBA 7A is capped at 5 million, usually 10% of the purchase price. And then they're amortized for a fairly long time, which I like. The SBA 504 is, it doesn't max out. And these loans can be up to 90% of the purchase price, regardless of the size of the deal. And that's usually a 20-year loan term. So types of commercial real estate loans. Again, the last one here I'm going to talk about is commercial mezzanine loans. So we talked briefly, I'm going back real quick here. We talked briefly about commercial, well, the conventional that you know, the commercial bridge loans, the commercial hard money loans. And now we've got the SBA, and then you have your mezzanine. And again, the mezzanine, think it's in the middle of that pancake stack. It's often used to fill kind of a gap in a number of ways. So you might have junior debt and you have senior debt. And you know, in residential that most likely you have senior debt on the property. You have one mortgager. You could get a second mortgage, but you have to have a lot of equity in order to do that. And that would be a junior debt, but they're only going to do it if you have significant equity in your property. Junior debt is you're in second position if that person were to default. So let's say the property's worth $1 million. You have a loan for 300,000. Will someone give you a junior debt of 200? Heck yeah, they probably would, because you have enough equity to cover all that if you default. If you owe 800 and you want 200, you're not going to get some junior debt. There's preferred equity is often used in joint venture situations. This goes to also kind of think stock option or stock scenario if you're creating a startup. The startup usually has preferred equity positions, and then you have preferred partner positions, and then you have common stock. Preferred equity always gets paid first. Common stock gets paid last. And you might even have dividends with regards to that. So that's usually in syndicate situations. Now, what the heck is a syndicate? I'm throwing a lot of terms at you. So at least you're going to recognize these terms as you're going through business. I don't expect you to really understand them all today, but a syndicate is where, let's say I find an amazing apartment complex. It's 120 doors and it, is a great opportunity, and they're asking 60 million for it. I can't afford that. So what I do is I create a syndicate and put all the paperwork together that is SEC compliant, and then I go out and get investors. And so these are passive investors that will invest, and they'll put in a portion of the funds, say 200,000, 500,000, whatever. And then you build that syndicate up with multiple investors and go out and purchase that property. And then what they do is they get a return, or they might get some sort of a dividend, or you're going to say in 5 years, you're going to get a 15% return on your money. So you either have an exit, you either have some sort of payment structure, whatever it happens to be, but that's how the preferred equity usually works. And then you also have convertible debt and participating debt. Participating debt is also part of that syndication, where you see that the investors will receive interest payments and share of the revenue. So that apartment complex, let's say you're making, a pretty hefty profit every month, then those people that participated in that may be getting a check. In addition to, in their exit, they may get a guaranteed 15% return on their initial investment. So, complicated stuff. Does anybody have any questions about commercial real estate loans? Any clarifications required or anything like that? Again, I don't expect you to really get all of this. I expect everyone to kind of have a good basis of going, oh, I've heard that before. Now I know where to look to figure that out. This is where the complicated stuff comes in. And if you're not a math person, or you don't like doing calculations and things like that, there's some great calculators out there that you can just refer to. It seems complicated. Back in the day, you'd have to carry your calculator around to do all this, and you had to know how to use the darn calculator. But now you can just use any online tool and you can pretty much figure this out. These are different metrics that are used for brokers, investors, etc., to figure out how valuable an asset is. And a lot of you have heard, what is a cap rate? Cap rate is a yield on cost expressed as a percentage. So what is your net operating income divided by your purchase price? Pretty darn easy to figure out. And you could imagine, if your purchase price is much higher, your cap rate's can be lower. So some people think the higher the cap rate, or a certain threshold for cap rate, is ideal. But if you're buying something in a growing market with a high potential for year over year yield increases, then your cap rate might not be that high. And you might be okay with that, because you know that that's in an amazing opportunity area that's growing. Internal rate of return is a tricky one. It's a more complex metric, but it's used by more savvy investors. It's an annualized rate of return that's also expressed as a percentage. I'm not going to go through how to calculate that. You can actually find a calculator online if you ever want to figure that out. Cash on cash return, it's expressed as a percentage as well, and it's your annual pre-tax cash flow divided by your total cash invested to date. So it kind of takes your cap rate and takes it one step further. Stabilized return on cost. I'm going to talk quickly about stabilized versus unstabilized. Does anybody know what stabilized is from an investment perspective? Has everyone fallen asleep on me? Anybody? Stabilized is, I'm keep using apartment complexes as examples because we all know those. But a stabilized apartment complex is one where the rents are market rate and the occupancy is at the threshold for which you want. So I buy an investment and I get it for a steal, but you know, there's a few vacancies because it hasn't been upgraded and market rates are below what they should be. Maybe because it is dated, so it's a value add opportunity investment. So I'm going to increase value by upgrading it, and then I'm going to get it fully occupied at higher rents, current rents, and now it's fully stabilized. So that's where you can calculate your stabilized return on cost. Equity multiple, the equity multiple of an investment is a measure of total cash return over the entire lifespan of that investment. So that might be required if you're selling it. And you want to have those details ironed out. Let's see. The CRE risk profiles. I'm going to talk about this real quick. And I mentioned value add. But there's a little bit more to this risk spectrum when buying real estate. And I always look at it from the perspective of your client and what their tolerance for risk is. And we all know that. We know that when we're dealing with, you know, our residential clients, right? Some of them have a high risk tolerance. They're like, yeah, I want to go in and get that and fix it up and put in some sweat equity, and I don't mind not knowing exactly what's in it, and I'm willing to go without a, you know, an appraisal or whatever. So they're a bit more risk tolerant. And so the same sort of thing applies in commercial real estate. So I'm looking at, Melinda asked, if you purchase an apartment for $26 million and want to make it below market rate, what kind of investment would this be considered? So you mean renting it out to a BMR community? Is that what you mean, Melinda? Yeah. I don't know if you would do that unless you were getting a grant to do that. So the only way the below market rate and the affordable housing works is if you're getting a grant from the state and or you're getting funding as a nonprofit. So I would never want to make a fully stabilized asset below market rate. And I work with a lot of affordable developers right now. So that's another interesting thing, because right now in the development space, we've have something called RHNA numbers, RHNA, and those RHNA numbers have been allocated by the state. And what that means is each city has to meet a certain threshold of development in terms of affordable, below market rate, and attainable housing. So a developer goes in, think D.H. Horton, they go in and they're developing 100 single family homes. Well, now they also have to develop 20% below market rate housing, which they lose money on. And the only way they can make that pencil is if they partner with an affordable housing developer that goes and gets the grant that actually pays to develop that. So that's, hopefully that answers your question a little bit, Melinda, but going off on a little bit of a tangent there. The risk spectrum, opportunistic, value add, core plus, and core. So opportunistic is really the riskiest real estate investments. Development opportunities are buying vacant building to reposition. So this is pretty much a lot of what I do, because if you think land or you think redevelopment, so some other terms I'm going to throw at you is greenfield versus brownfield. Greenfield is a site that hasn't been built on before. It is just what it sounds. It's green. There's nothing that's ever been built on it. You don't have to worry about any sort of weird CEQA or any environmental issues. But a brownfield could be an old air base and it's got munitions and things like that. Or a brownfield could be, let's say it was an old dry cleaners and now it's been rezoned, or you want to rezone it for high density residential. That sounds like a nightmare to me, because dry cleaners have the worst from environmental impacts and issues. And so the cleanup might completely take away from any potential profit. Because you may have to do remediation and things like that to clean up the ground, the soil, the site, whatever. And then all of a sudden now you're $3 million in, and now you have no margin for profit. Very opportunistic. And buying vacant land to build or reposition, this is when you really get into that entitlement period as well. So I'm going to take an existing site, it's currently used as A, and I'm going to do B with it. I have to go through a 2-year entitlement process, surveys, environmental reports, analysis. And then at the end of that 2 years, I can release my due diligence and then I can purchase it. So that's usually what I do. Value add, or assets with opportunities to increase cash flow. So again, non-stabilized, right? So now you got that apartment complex that has old bathrooms, old kitchens, whatever, and you're going to go in and add some value. Now, you're not sure what you're looking at in terms of investment. You can do some rough estimates, but you may come across some issues. Maybe it's a historical building, and now, you know, there's going to be an issue with that. So a little bit higher risk still there. Now you're moving down the spectrum into least risky. Now we go into core plus, which are assets with some component of risk, that it could be the location, or it could be a different risk profile that you're looking at. So the location, maybe you're posturing that location is gentrifying, right? And you're seeing it go in that direction. So you can still make a decent cash flow on it, but you're really banking on that in 5 years, it's going to be an amazing area and you're going to be able to double your rents. Core is the least risky real estate investment, traditionally high quality, centrally located, well maintained. What asset class would a core be? Anybody? Asset classes being A, B, or C? Okay, well, I know a lot of you want to see, yeah, thank you. So it is an A. So you see how it all kind of plays together, knowing some of the terminology and understanding, you know, what A is versus B versus C, and then also what is their risk tolerance. So I think a lot of this language also can be used with your residential agents, but also if you want to help them find a secondary investment. Say it's a single family home and they want to invest and you're representing them. Using this terminology and using kind of this basic training is going to help you expand your knowledge in order to better serve them in that single family asset. You know, maybe they're doing a short-term rental or a long-term rental or something, or maybe a fix and flip. This is all going to help you in that analysis as well. So I guess I actually went through this fairly quickly. And I have my contact details here. And I also would love if you could scan this and give me your feedback. I am going to get KWU certified, and I have to have something like 70 responses in the survey in order to, you know, go through the whole process and get it done. So if you can give me an eval, that would be great. And then I have other courses that I'm going to offer, but next week, let me jump back up here, just close your eyes so I'm not going to confuse you here. Next week, I'm going to go through the acquisition and divestiture process and portfolio management. This is super important for you residential agents that maybe you want to help your clients look at increasing their portfolio. It could be single family, it could be duplexes, it could be whatever else. It could even be medical condos, and I can help with that. Those are really fairly easy to acquire and manage. So it's a great way to kind of think about getting into the investment ladder in terms of complexity. I wouldn't start off the bat with industrial. I wouldn't start off with, hotels. I would definitely start out with medical condos or maybe smaller retail spaces or something like that, and really help your clients think about portfolio and how to really diversify and increase that. And then also talk a little bit more about the clients, the partners, and the tools. And then in the final session, leads, deal funnel, how to partner with the commercial agent, and what's the future outlook of commercial real estate, and how we can dovetail the future of residential, and how you can have some conversations with your clients about that. So I'm hoping this was useful for you all. And at least there's a term or two that you put together. And I said this last time around, but I'll say it again, that if you don't have a problem, you usually don't find the solution. So I just gave you a whole bunch of problems. And what I mean by that is, the example I always give is, the problem is your car broke down, you need a new car. So now you notice every car on the road thinking about what kind of car you want to buy. So now I plop these terms in your head, and now you're going to be noticing more that people are using these terms, or you're going to be able to apply them and look them up again and use them correctly, because now I've given you that problem. With that being said, any last minute questions, feel free to unmute, comment, ask for any more clarity or any other topics that you would like to hear about.
Hey, Danielle,
Yes.
I have a question about converting a commercial space. It's a building that has like a bunch of, like a strip mall would have, and above the little spaces downstairs, there's a lot of like, it's an office building basically.
Uh-huh.
And so what would be the process to convert something like this, if even possible, to a residential? If you can just, you don't have to go into details, but like,
No, there
generally,
is,
is that possible?
yeah, there is new legislation that makes it a ministerial process. So underutilized commercial space can be converted into residential. You do have to go through certain processes to make that happen. I think you can sidestep the CEQA, and some other things, and it's more ministerial. Do you have a site in mind?
Yeah, I actually do. Yeah.
Okay.
And it's been vacant for a very long time, and nothing seems to be happening with it. So I'm in the process of finding out more about this.
Well, if you want, give me a call and we can pull up who the owner is and get some more details on it. I have some tools that I can get all of that data. And then maybe go in with a proposal of how to remarket it. I currently have some land for sale in Oakley that was zoned mixed use retail. And it wasn't selling because that's just not an asset class that's selling right now. Retail and office are real tricky. And so what I did was I reframed the brochure and the OM, and I put it as high density residential, given the new legislation. And now I'm in contract. So
Wow, that's great. Yeah, definitely. It's basically become kind of an eyesore because it used to be pretty dynamic and whatnot. So anyways, yeah, definitely. I'll check in with you.
well, and also if any of you drive by a building and you see it and you think, huh, that's underutilized, especially in the Bay Area. I have developers that cannot find enough land. I have people lining up. I have more buyers than I know what to do with, and I cannot find land. So I'm literally cold calling constantly. So if you drive by an open lot or a building or a structure that you think is underutilized and not being utilized, take a picture, send it to me. And if I actually end up getting that listing, I'll give you a referral fee, and I'll go off and I'll find out who that is. Or we can partner on it. Because I do so many off-market deals right now too, or I'll just call up the owner and just say, have you thought about selling? I have people that are chomping at the bit, and there's 56 new laws that have streamlined building and conversion. So it's just insane. The need is huge right now. We just don't have enough places for me to place them. I think case in point, Abby is on the line too. I identified an ideal site in Morgan Hill that a developer of mine would love to have, and I asked Abby to help me try and find the owner of it and see if we can't secure the listing, offer on market. I could sell it off market in a heartbeat. Doesn't even have to go on market. I got people lined up. So if anybody needs any help or any advice or any guidance, feel free. I love doing this stuff. And I love being really creative and looking at ways to take assets and repurposing them and ultimately getting them sold or getting them into contract and going through some entitlement processes. But again, just, use me as a resource. And if it's an area that you think you might want to jump into, again, you can't just, transact because there's no E&O insurance for you in our brokerage, but you could definitely work on that path to get commercially certified and start working forward. Anybody else? Any other questions? Awesome. Okay, I hope you can join next week. And then we can just dive a little bit deeper. I'll do a recap again, and then feel free to send me any questions directly, and I'll make sure to get them done in the next session. And I'll ask my assistant to send these slides out to everybody that joined. Okay, everybody have a great weekend. We'll
Thanks.
be in touch.
I'll be in touch. I did your survey just now.
Thank you so much. I appreciate it,
Okay,
Marilla.
thank you. Yeah, I'll be looking for the slides, and I will probably give you a call about this. I'm gonna go find out a little bit more, so I have the info for you, and I'll reach out.
Even if you have cross streets, I can find it. So.
Yeah, I need to go find out. Sorry.
Okay. Awesome. Thank you so much, everybody. Take care.
Okay, have a great weekend.
Bye-bye.